Howdy, Jacob here. Today we're looking at Davita Healthcare Partners in the healthcare provider and services industry, incorporated in 1994 out of Denver. They provide kidney dialysis services for patients suffering from chronic kidney failure in the United States. 13.7 billion market cap on 21.7 billion enterprise value. So big company, but big debt. 12.8 billion in revenue in 2014, a little bit down in 2023. It looks like it is pretty flat, maybe 1 to 2% growth from 2015 to 2023. I wonder what happened in 2015. Let's see if the cash flow statement has anything there. I don't see any big sell-offs, so there must have been some change in business to incur this much revenue decline. But gross margin at 31.5% recently, operating margin 13%. The good news is operating margin has not been below 18.3% the last 10 years, so they have been very consistent with their bottom line. Return on invested capital, pretty poor if you ask me. Their income statement does not show any R&D, so majority of their costs is going to be cost of goods sold. Balance sheet shows about 392 million cash-like products, 123 million short-term debt, 8.2 billion long-term debt. I don't like this debt. That 8 billion long-term debt in relation to their free cash flow is going to be a little over 5 years if we're saying 1.5 billion, which would be very generous. So probably looking at 6 to 7 years of their free cash flow in debt. And they haven't historically, at least more recently, bought back a consistent amount of debt. I will be putting that into my assumption as my forecasts project 100% use of free cash flow. I'm going to assume about 20 to 30% free cash flow is going towards debt reduction, leaving a majority of the rest to go to share repurchases and a little bit to acquisitions. So let's get right to it. Why waste time? Revenue growth, I think they're probably able to grow with inflation. I don't know why they wouldn't. With their enterprise value being so much greater than market cap, probably fine with the 12 on the P, price to free cash flow. As for margins, 6 and 10% are the historical averages of the last 6 years. I guess I'll go 6 and 10, pretty big range. Share repurchases, they do buy back a lot of shares, so 137 million is about 1%. If we were to assume about half of their capital allocation goes to free cash flow, maybe 40%, looking about 600 million, 500 million if you take out share repurchases would be about 4%. I think 4% is assuming roughly 50% goes to share repurchases. We're saying about 20 to 30% to acquisition, 20 to 30% to debt reduction. That's their full use of free cash flow. And the company's stock price needs to fall 48% before you get the return we're looking for here. So these type of companies are interesting when they do have a lot of debt. They're able to buy back a hefty amount of shares, but they still have debt. And debt can be a huge burden on a business. Obviously, I'm not looking exactly at when that debt is due, but it can be an absolute problem. And so I would want them to be focusing a bit of their capital allocation on reducing that debt and not just maximizing shareholder value on the shareholder equity side, but not really caring about the true scariness that can come from holding as much debt as 6 to 7 years of free cash flow can do for you. So for me, I'd want them to be doing, like I said, 50% roughly share purchases, 20 to 30% acquisition, 20 to 30% debt reduction, and it needs to fall in half. So hopefully everyone enjoyed this video. Has a great rest of the day. Has a great rest of their day. Thank you.